Okay, so we know some basic stuff. We know some basic stuff about portfolio theory now. And so let's talk about other investment strategy issues. And there's going to be a big, big division between two ways of looking at investing. One is what we might call a trading mentality, where someone's objective is to buy low and sell high within a short window. And so we might sort of think of this as the day trader. Someone who thinks they're going to get a hot stock tip, that something's going to rise in price and they're going to sell it like a week or two later. And we would also sort of contrast this to a longer run, what we would call a fundamentals mentality. The first phrase, or the first school here, is also sometimes called technical analysis, or chartism, because a lot of what happens in people who are sort of looking at this world and looking at the world in a sort of immediate buy something low, sell it high very quickly soon afterwards, is that they're looking for some sort of reliable pattern with stock prices. That, you know, if something is trading a lot below what it's traded for recently, then it's going to go back to where it was recently. Or if something's sort of bumping up against the top of its range and it's broken out of its previous trading range, then something has happened and it's going to keep on going up until it reaches some new equilibrium level. And there are relatively few things where I can speak with such confidence, but this idea that you can predict future stock prices or future asset prices using just past asset prices or stock prices without reference to the underlying fundamentals is absolute nonsense. It's just complete snake oil, complete BS, and there's nothing to it. And essentially one of the people who won the Nobel Prize for 2013 actually was someone who thoroughly showed that, yeah, all this stuff of trying to predict future stock prices based on past stock prices is just hokum. It's just, it's just nonsense. And again, there are relatively few things where I can speak with such confidence and authority here. As an example of why this sort of thing tends to break down, there used to be what was called the January effect. And the January effect arose because of the following thing. It used to be, of course, and still is, that people might sell stock at the end of the year for tax reasons. So what we would typically see is that stock prices would decline somewhat in December, and then in January they would come back very strongly. And eventually someone discovered this, some academic discovered this and wrote a paper on it and published it. And lo and behold, once that paper was published, everyone realized, oh, so what I should do is I should buy in mid-December when the stock prices are low so that I can profit off that January effect. Of course, that meant then when January started, stock prices were not artificially depressed because someone had stepped into the breach to buy those stocks that were artificially low. So what we tend to see here is that if there is any kind of exploitable pattern to asset price movements, that people quickly adapt and start exploiting that pattern. And once they start exploiting that pattern, then the ability to make profits off that anomaly in stock pricing, or that predictability, and predictability really is an anomaly, goes away pretty quickly. So maybe someone has some super secret trading strategy out there. But if they have that, what are they doing selling books about it or going on CNBC or whatever and talking about it. Because, of course, as soon as they divulge that to the public, everyone else will be able to undo their strategy. And probably if anyone has a super secret trading strategy for making lots and lots of money, probably they're keeping it to themselves instead of using it to try and sell you a book about it. So, generally speaking, economists, people in finance, Warren Buffett, et cetera, are going for this fundamentals mentality. And the idea here is that we judge the value of an investment by looking at the underlying economic fundamentals. Not just current, it might be future. So it might be that a company has no profits right now, but the FDA has just approved some wonder drug, and we expect them to make large profits in the future. But essentially what we're going to do here is we're going to estimate the present discounted value of the dividends or the coupons or whatever it is that this asset pays out. And if we can find something that is selling for less than what we think is the present discounted value of the payouts, then that asset is undervalued, and we should buy it. And notice we now have two ways to make money. Either the asset can stay undervalued, in which case we're making a lot of money per dollar we spent to buy it, or the rest of the market can come to agree with us, and the asset will rise in price and we'll make a capital gain. So we don't have to have any particularly sharp insight into other people's psychology and knowledge to be able to make this investment strategy work. A little bit trickier, we could also try to identify overpriced assets. Assets that had a market price that was above the discounted value of their payouts. And in that case, we would sell those assets short. So those are the sorts of investing strategies that most professional finance people tend to follow. So how do professional finance people tend to do? Well, this is sort of a little bit counterintuitive, but most professional finance people can't beat the market. And I know I just said that. Most professional financiers can't beat the market. So of course, on average, the stock market goes up most years. So just being able to make some money isn't any kind of skill. You know, a computer that just randomly selected things, or a monkey that threw darts at a dartboard with stock prices on it, it should be able to, on average, match the market average. And, you know, this is sort of surprising. It's kind of a surprising result that these people who are intelligent and highly educated and put in long hours, that most of them can't beat the market. And the reason why is that this is an essentially competitive process. It's just like most batters can't bat 500 because they're up against professional pitchers. To be able to beat the market, you would have to be better at identifying mispriced assets than all the other professional finance people out there. And of course, most professional finance people are of about average skill compared to the other professional finance people. They're very highly skilled, but they're also up against a very large group of highly skilled competitors. And so most can't beat the market. So most financial advisors say then, well, if a professional money manager, say for instance, or someone who's running a mutual fund can't beat the market, then why should you pay them for that? And indeed, most financial advisors, I think, are going to steer people towards what are called index funds. So index funds have low expenses and just try to match the market. And in that way, you know, at least you're not paying someone for something that they can't deliver. And you're just sort of riding the wave. This whole issue of people not being able to beat the market is, I think, something I would have a little bit of a grain of salt when interpreting. I think most people, when they run these tests and when they write these papers, they look, can people beat the market within a given asset class? And what happens is that typically there's money that's been invested in mutual funds, and a mutual fund invests its money for a particular purpose out there. So it might invest its money in small tech companies or utility companies or Venezuelan beaver cheese companies or whatever it is that that particular mutual fund is devoted to. So the managers of the mutual fund are policing asset prices within that asset class. They're always looking for mispriced assets within that asset class. But if I'm the mutual fund manager for a small biotech company mutual fund, and I think as a whole, biotech companies are overvalued relative to utilities, there's really not much I can do about that because I'm limited by the constraints of the mutual fund, the rules that I'm supposed to follow when the investors hand their money over to me. So the idea that financial advisors can't beat the market, I'm pretty confident that that's true within a given set of investments, say within stocks or within bonds. It's a little bit less clear whether or not that's going to hold to whether or not people can beat the overall idea of, well, which sector is going to do better this year, stocks or bonds? Because there's no ability or very little ability for money to cross over from one asset class to another.